A Spanish 10-year bond auction attracted good demand, but borrowing costs increased. Solid earnings reports out of the U.S. from the likes of eBay and VMware is helping to boost stock futures higher. I'm Taylor Schrantz, and the morning call starts right now.
Good morning, I'm Scott Rudler, Chief Strategic Officer of T3Live.com.
And I'm Lindsay Bell with The Street, and together we bring you the morning call. The stock futures are pointing up this morning, but it's been a roller coaster ride for the stock market. It's almost been a tug of war between the bulls and the bears. We got some mixed earnings out this week. We got good numbers from Halliburton and VMware last night, but to a lesser degree, IBM wasn't so great.
Yeah, you've seen a very stock-specific tape, a very earnings-specific tape, and as far as the action, it's been choppy, but it hasn't been devastating. It's been very tradable, actually. You know, the market showed the writing on the wall when it looked as if we were going to correct with the distribution days, but we've only seen about a 4 to 5% correction off the highs, depending on the indice that you look at. So what everyone's trying to figure out now, was this the oversold bounce back and do we continue lower to new lows, or was that the correction? So every single day we need to judge the composure of the market, the earnings and what's going on in Europe in order to figure out what type of risk we need to put on.
You bring up Europe, and this morning we saw a Spanish bond auction that was decent. There was good demand, but it wasn't great. Borrowing costs still went up. What should we expect from Europe?
The borrowing costs went up, but it wasn't like drastic or devastating. It was decent. So I think as long as we get decent, not drastic out of Europe, we're going to respond okay, and we're not going to get, just say, crushed. If you look now at a chart of the S&P, you will see that yesterday, even though we were down, it was somewhat of a constructive day. You know, if you look at the chart again, here is the macro trend line that we've been following. We've been following it for a while. We came in and tested it, okay, way back on, what was that, April 10th. Since then, we've had a choppy / methodical bounce right back up to this broken trend line. And that's what you do sometimes. You retest broken trend lines. So how you handle yourself there is key. And then yesterday, we had an inside day. Dow was down, I think, like 80 points or so. But if you look compared to Wednesday, it was still in the top half or top third, still held the 50 days, so somewhat constructive. But if you look here, this to me is what you call an ascending channel. Ascending channels typically break to the downside. So I think you have to be somewhat neutral here, keep taking your trades, but if we start to get below 1370 and if we close below 1370, I think traders will start cheating to the long side for at least a retest to 1357, and then what could be a move to major support right around 1340.
Tech was a laggard yesterday, and part of that was earnings out of IBM and Intel that didn't meet market expectations. But last night we got some good numbers out of some of the Qs.
Yeah, well, if you look at IBM last quarter, I think everyone was really concerned about the European exposure. And then this quarter, people kind of forgot about it. So they saw the report. They saw that there wasn't really a lot of growth there. It was solid. And people don't know where IBM's growth is going to come from. But if you look at the chart, which is what I look at, it broke an important area. You know, this stock broke this support that we've been watching since, I would say, mid-February. This was, what, 201, you know, the 202. It broke below it, closed on the low. So if we just lost IBM in this rally, could be a little bit of a problem. So for me, I think IBM next real level here will be 195 to 196. If you did not take it into earnings because that's not your risk, then I think you could look at it as an opportunity because down here at this area, it could be buyable. And we also talked about Intel yesterday. Intel acted a little bit better. I thought Intel's report was solid. Yes, I know that their margins were a little less, but all in all, I thought that they did good, and they're still above 60% on margin, you know, or their margins. And we talked about 27.45. It wound up being a good cash flow trade for those who didn't take it into earnings. And now I think you could trade it long versus this level here, which is 27.40. So you go across. It held the 50-day after a huge move that we've seen in Intel. So all in all, I think it's half full in Intel and a bit half empty in IBM for right now.
How about we talk about Apple? This is a stock that you've had a great call on, but yesterday it wasn't able to hold the upside that it got from a Goldman upgrade on the price target.
I think you can't look too far into that because of the size of the bounce back. So there was a lot taken out of what could have been an up move with that upgrade. And with Apple, you know, as an investor, if you stayed the course, you're doing really well as a trader. Lately, you can't be upset because the writing's been on the wall with Apple. If you look here at Apple, you know, we started talking about the divergence in Apple way back when. Remember last week I was talking before the Boston Marathon. If we break below 620, 622, you got to get out or got to get short. You know what? If you got short, you didn't know you were going to have a 40-point plunge, but if you're on the right side of the trade, you don't have to. And it came all the way down to this prior support. And then, 2 days ago, Lindsay, we were here, and I'm like, okay, guys, you made your money short. You should be covering. It's a 10% move off the highs. I want to look for a red dog reversal. And I came in after, being out of the office for a day. I'm like, you know what? I'm just going to look for the setup, the strategy. If it triggers, I'm going to go with it. And that's what's great about a strategy if you trust it. So if you go back to Apple on the chart, you'll see same way you didn't know it was going to drop 40 points. Once we triggered back above 578 and a quarter. You got long with a stop at 571. You didn't have to know it was going to go back to 620 either, but if you did the right trade, you got rewarded. Yesterday, it was an inside day. Some guys actually made some cute money short. So now for today with Apple, I think if you are a trader, you watch this inside range. I don't think it's going to be as big or volatile. You have yesterday's low of 602.71, and then you have the high here. Let's see if it stays within this range, and we'll look for a better setup as we move forward. Still above the 50-day, still looks okay, but earnings are about a week away, so we'll probably revisit it a little bit in depth then.
Financials this morning, Bank of America came out with earnings, and the stock's up 4% so far this morning. But this is a sector that we've seen JP Morgan and a couple others that, they really sold on good earnings reports.
Well, that's
what's going on with Bank of America.
Well, Bank of America, I think right now is up 4%. So you just mentioned that JP Morgan and Goldman Sachs came out with decent reports and they sold them. So we want to see if that changes today. If you look at the chart of Bank of America, you will see it already had a nice correction off the highs, so it wasn't expecting much. It was as high as $10 and change. So what did it do? It came back and retested. If you guys remember how you could be a trader here, this was the last time I was excited about Bank of America. Nice tight pattern. We were buying it above 815, 825. Pow. Then it broke down with the market, and now it has a lower pivot here. So we'll see if it could get above and stay above. Right now it's opening into 950, a decent resistance. So I don't know if you should just want to go out there and buy Bank of America, especially looking at what happened with JP Morgan. But again, we want to talk about direction of the market. I think, you could simplify it. So here's what I want to do. I want to simplify it here for you. As long as JP Morgan stays above, just say 42.50 to 43, I think the market hangs in there. We start breaking below 42.50, 43, and go to the downside. I think we see more corrective action in the banks and the market. And if you want to go to Goldman Sachs, same thing. Look at this chart pattern right here. Okay, it's hovering around 114, 115. If this starts to close below 114 and a half, I would start cheating and start thinking more hedged, more net short, because then we could see some more corrective action here as well. So watch these banks for helpful hints on which way the market's going to go.
How about Visa and MasterCard? These are two stocks that they've had a good run, and they're hovering near the 52-week high. Can the momentum maintain? We heard from American Express last night that consumer spending was really good, and I know it's a different level of consumer, the higher end in American Express. So what's the momentum look like in these names?
It all depends if you're a long-term investor or a momentum trader. As a momentum trader, you've been very rewarded. As an investor, you've been very rewarded. But in a corrective type tape, if you're a little risk averse, you might want to stay on the side. I have a little bit of a cough. Anyway, Starbucks. If you look at Visa, you will see it hasn't given you a reason yet to run for the hills as a macro investor. You've had a very slow, methodical move, as it's extended higher, still above the 50-day, still above all these moving averages, and now it's wedging again. There's always a little bit of risk going into earnings, so I would say as a macro investor, being tier one or maybe hedged as a momentum guy, wait till after the earnings. If it can hold above the highs, then you trade it.
So for the financial and tech stocks, you really got to watch some of the key levels for them going into the earnings.
Yeah, and if you want to take a quick look at the Qs has a bit of a different pattern here, and they've been the leaders. If you go here, you will see the Qs have somewhat of a descending channel, meaning look at the move we've had since the Bible breakout back in earlier this year. It was around 60. Huge move to almost 69. Right now we've had a methodical, controlled pullback to the 50-day. So at this point, we're opening up just a little bit. If the Qs can get above 67 and hold above it, then maybe we'll see more of a constructive stance. If we continue to go to the downside through the 50-day, obviously we could see lower prices, and that's when we get some bigger support coming in below 64. So right now, it's a tricky spot. No need to be all in, no need to have excessive risk. Traders are making money both long and short. Stay that course. If you're a macro investor also, don't let people all over the place talk you out of positions if you have a longer-term time frame.
We're going to take a closer look at some of the tech names when we come back after this short break, when we get into the trenches.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Let's get into the trenches with Amex. They traded down after earnings yesterday, which were good. What was interesting about that report is that they were able to cut costs. That was something that the bears were looking at. And this remains a really high credit quality name, too. But what are the charts telling us?
Charts are saying, first of all, you never want to see something sell off on good earnings because that just means that a rest is due and it could be priced in. Doesn't mean it's game over, but it's a short-term warning signal. So if you look here at Amex, you will see that yesterday you had a bit of a red dog reversal to the other side, or some kind of open up higher, close near the lows. So that's something you really don't want to see if you're playing it for short-term momentum. Some guys, now that the earnings are out of the way and they see it push through here, they might be looking to get short because you also have a lower high. Here's your high, here's your lower high. It's well above the 50-day. So it is a bit extended, and if people think there's going to be a market correction, why wouldn't this come in? So I would say if you're a macro investor, you probably are okay moving forward if you have a long-term time horizon. As a short-term trader, I would use yesterday as a sell signal. Some might even be short versus yesterday's high. And if you are, use that as your stop. And then here's your support right around 56 and change.
You mentioned the Qs already. F5 Networks, they were one of the components of the Qs that reported earnings last night. They were good results, and the stock's actually trading up. Now, that stock traded down 10% from the high that it saw in April. Is that maybe that's why the stock's trading up and not selling on the news?
Right. Well, they didn't price in that much. They didn't think that there was going to be such a great report. So when you don't rally into a report and then you get one that's pleasantly surprising, you have shorts in there. It creates a dynamic. Sometimes you get a big gap up, and that's what's happening here. If you look at the chart of FFIV, it's okay. It wasn't really acting well going into it. You had this lower area where it was holding on support. It was below the moving averages. So that's why a report like this was somewhat surprising. I would not chase this gap up. Okay, I would let it trade today. Some might even short versus a 15-minute high. Here is some big resistance. So I would say right down this area. This is about 134. It is a quality name, but it's not the best of the best. So if you're not involved as a trader, use the first 15 minutes to your advantage. It can gap up. If it shows a negative divergence, maybe you short versus that. If it pulls in and shows a positive divergence, maybe you buy it versus that low. That's how you could trade it. But to buy it as an investor, let's let it finish the day, go sideways, hold an earnings gap, and then I'll get you another entry if it's warranted.
VMware is another tech name that beat, and the stock's trading up. This is a cloud computing name. They've really been able to use innovation to take share from competitors like Microsoft and Oracle.
Well, this stock has been one of the go-to macro investments. This is something that I do think has the high quality that if you needed to be one of these names and you want to sleep a little bit better at night, it's been VMW. The question is, with this market, do they sell the good earnings? Will it gap up and go, or will it gap up, show a negative divergence, and come in? If you look at the chart here, it's priced in a good report. If you look here, remember when that news came out, that's one of their high-level guys were leaving. I don't know exactly what it was, came in. It was actually an opportunity on the 50-day into this prior breakout. So some guys that bought that down open, it was down like $8. I remember that day. They made money. Since then, it's been wedging. It's been tight. People don't know what to do here. Is it going to correct, kind of, make another move? So now I would say watch this. 115. You have 115 here. This is very big resistance. If it opens up here and fails, it's going to need more time. If it goes there and the bears can't sell or it can't go down and it continues to break out, that would give us a few more positive, constructive clues that the market's not that weak. But if they sell another good report, that will tell me caution, and that will keep me on the sidelines just actively trading versus putting back a portfolio approach.
Qualcomm, they beat earnings, but the stock's trading down. They guided lower than expectations there. This is kind of an Apple play.
Yeah, well, Qualcomm has been a darling. I was with this in the first quarter. I tried to hold it for a good 2-3 months. It was rewarding. Since then, I haven't really traded it. If you look at the pattern here, though, they were expecting a really good report. So if you go to the chart, you'll see it's been choppy lately, okay, but really, the size of the move that it's had above the 50-day, and I think I was trading it right around this area, right when remember this is what happened the last time. Last time you had an earnings report after a big move, it went sideways, it held the gap, and it gave you a good entry point to what has been a big move. Now with a little bit of softer guidance, what I would say is use this 66 area or 65.50. If it can't bounce off this 65.50, I think some guys are going to try and press it and short it for a move to what could be, the 50-day moving average here. But I would be a bit careful. Watch the price action in the first 30 minutes. If it does get below and stays below and all these people remain trapped, you might see more downside, and then you could actually wait for a new entry, and that new entry might be down to 62 if they don't come in there and try and save the day today.
Changing sectors up a little bit, let's talk about Yum Brands. They reported earnings last night. The stock's trading down a bit, and that's because these guys, they're KFC, Pizza Hut, and Taco Bell. They're expanding in China heavily. Same-store sales came in a little bit weaker than what analysts were expecting, but they were still up like 14%. So what should we expect today on this one?
I think, from just reading the headlines, they're talking about how it showed that China is slowing a little bit, and that's been one of the concerns of the market, that China is slowing. If you look at this chart, it's been just methodical to the upside, so any kind of disappointment, it should have gotten a little beat up. And if you look here, the question is just how beat up will it get? It's had a huge move into earnings right near the highs, so they were expecting something powerful. It wasn't, so I would say, if you're long it and your time frame, just stay with it. If you have big gains, make sure you have high level stops. And I would say, for a re-entry, if you don't take it into earnings, this spot at the 50-day again will be the spot where you could re-enter, and that's closer to 68.10 versus up here. Obviously, you want to see what type of move it has. What you want to do is when a stock gaps down like it on earnings, you want to see, does it come off the lows where it's priced in, or does it close at the dead lows, meaning you got to get out of the way for what could be a few more weeks.
Speaking of a stock that went down after earnings, let's get into the quick hits with Google. It's been trading kind of around 610, but is it going to be able to get back up to 650 where it was before earnings came out?
I'm not sure. I think people are starting to lose a little faith in Google. Even myself, I came into the year, chart pattern looked good, and then the company misstepped twice. 2 bad earnings reports. So people are like, okay, I got to give this more time, or I don't want to be involved. And if you look at the chart here, you will see that it did give you a way to come, somewhat get out of it if you were in it on earnings day. It opened up and then just got crushed. You never want to see a day where it opens up, closes on the dead lows, because look what it does. It gives you more downside. Now, if you look here from October, this is something I went over yesterday. Look at this trend line that was broken. Okay, so this trend line was broken, and I'm not saying it's a Netflix, but remember last year when that trend line got broken, you had to take your opinions off the table. So right now, I'm somewhat taking my opinions off the table with Google. Right now, it's at support. It's trying to hold 600. I would say, though, the longer it stays below the 620 to 627 and goes sideways, especially if the market bounces, the more it's going to show you how weak it is. And then I do think traders will start to try and short it once it gets below the 600. Last time on earnings, it held the 200-day. Let's see how it acts again. So that 200-day comes in right around 591. So right now, here's your short-term pivot. Here's a longer-term support. And this is the area where it's going to be a fight between the bulls and the bears.
How about Starbucks? This one rallied a little bit yesterday after a pullback that it saw. Is there more correction, though, in this one coming?
I think Starbucks just needs time. It's been an unbelievable move. It's been one of the chosen ones. It's one of the, almost, if there were 5 horses, it would be in the top 3, and it's Starbucks. We talked about this with Jill back at 50 when it broke out. If you take a look at the chart real quickly, you will see, there are entries and exits and everything, and this is when we talked about it, and she said, I'm going long it, no type of, hedge type play, and I think I played it for these 3 days only, and then look what happened. And now, you have 2 big distribution days, so to me that says some people are shaken up. I think it needs time. I would say let it go sideways, let it build a new channel here, and then at some particular point, maybe it gets going again. If you're in it, I think it's okay. If you're a little bit worried, I would watch this area here. If you want to be uncommitted, if it breaks below 58.18, I would say sell it, and then figure out where the next buying opportunity is, because obviously look at, how extended it is, and who knows what happens. So I would watch it versus trend line if you're an intermediate trend guy.
What about Dunkin'? That's one that you like.
Dunkin' is actually just sitting in my account because I want to have people try and hold on to this one because it's a new issue. It's been out for 11 months. I don't have a lot of size in it. I'm just keeping it on the radar. I do think at some time it makes new highs, and I think it'll be good for people's overall longer term portfolio. If you look at the chart here, as long as it continues to act decent, I'm going to stay with it. I'll show you to this way. Here you are. Company came public right back here. You do have a nice, this was like my cup. you know, and then you had your resistance, and then this was a bit of your handle, okay, and then it had the secondary. So last time I got involved again was when it had the secondary and held price right around $29.50. As you can see now, get a little closer look here. It's not a barn burner. This is just like an exercise I'm trying to do with my community because I want them to stay with something. It broke above this area. It's flagging again. If it starts to get above 32, I will add. And then if it gets above the highs here, I think you could be in a core position. And then at some point this year, I think we'll be talking on Morning Call. This thing will be 67 to 40 bucks. I'm not 67, sorry, 37 to $40. Sorry, I was talking a different stock there. But new highs, nice gains. There'll be a few different trades along the way, but I do think you could put it in your IRA or somewhere and just, you know, let it sit there.
How about gold? That has really pulled back. Do you think we're getting close to an entry point?
I've tried it a few times. I got stopped out a few times. Right now, the long-term trend in gold is still intact, but the intermediate trend is still to the downside. And that's why we talk about knowing your time frame. And if you look here at GLD, you'll see exactly what I'm talking about. If you guys remember on that Fed day when you had this harsh down day, and I said this day will control the move in gold for I don't know how long, but we'll see. And since then, it's just been slowly trending lower and controlled by it. It's had a few different rallies that were fake outs. So if you look here, it came back to the trend line, failed. Came back to the trend line, failed. Came back, failed. This time really got me because I was long here, I got stopped out. And now there's a bit of an inside range here. So I would say look at this inside range right there. Okay, if you want to cheat a little bit, and so far I've cheated a few times and I've gotten caught and got hurt because it wasn't ready yet. If it starts getting above 161, maybe you start adding to it, but really for this intermediate trend to change, it's got to get above this high here of about 163.20 and close above it, do some sideways action, and then maybe it can continue because if you look at this macro chart, it's just been in a real corrective phase ever since actually this August outside day, which is why I love outside days. If you look there, I haven't shown you that in a while. This was your sell signal. This is when everyone was saying 2,500 for gold, and it opened up, failed, and it's been trapped in a downtrend ever since.
And when last hit, Apache, the energy sector has been kind of lagging. Stephanie Link, I know, got out of this about 2 weeks ago. It's traded down quite a bit. Can we get in, or is there more downside?
I'm just avoiding. I don't even want to talk about it.
You don't even talk? Okay.
No.
Never mind.
Get rid of that one. We're running late anyway. I do think, though, Halliburton is something I just want to add because they did have good numbers and people love this name and it's starting to act a little better. So if you look here at Halliburton, big, nice wide range day. It's opening near the moving average. This is one of the names maybe turn the corner that you could invest in. I know Goldman upgraded it, trade it long versus like 32, and perhaps at some point this year, you get higher prices. So that's something I think is a bit safer. Different, but safer.
Different. So we're in earnings season. Should people be waiting to hear conference calls, see what numbers come out, and then how the stock reacts before getting involved?
Well, it all depends. I just think if you're involved in a stock, know what it did going into it. If your stock ran 3 days in a row going into earnings, then it's a good report and opens up and then closes on its lows. You're like, why did that happen? The report was great. Know that it just ran 3-4 days into the report and it was priced in, and that's the way Wall Street works. If your stock was beat up for 4 days and then all of a sudden they were like just in line and it's up and you're like, why is that up? It was in line. It's because it just got beat up for 4 days. So you really have to know where it's coming from, what the report's expected, where the whisper is. Make sure you know your time frame so you know if it's a miss, that if you're stuck in the penalty box, you're not pulling your hair out and it's not, doing something to your life to the negative side. So for me, for earnings, what I do is I don't trade into earnings. I look for the report. I know the technical levels and I trade it after hours. But you have to also be very seasoned to do that. But again, if you're a longer-term investor and you don't do that, then just know your time frame and know that you could have some hedges out there as well. So if you do get put in the penalty box, some of that downside is muted.
So have a strategy going into earnings season.
Exactly.
And we have plenty of those coming out today.
There you go. So there'll be more than enough action, and as we go through the harder earnings season, we're going to judge the action of the overall market, so we'll know whether or not that 4 to 5% move off the high was the correction, or do we get some more downside. But I will say I'm in the camp that we're not going to be like last year, which this is a kind of an opinion, which I don't like to have opinions. I don't think we go 22% off the highs like we saw last year, but I'm also not sure that the move we've seen already was enough. So I don't think you need to be all in. I think you could take trades if you have a macro stance, be in tier 1, not tier 2, and let the market prove that you could put more risk on, because right now it still has a lot to prove. Have a great day trading.